I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to the Goddard Report. Comments made on the Goddard Report and TalkDigitalNetwork.com are an expression of opinion only. Here is Jim Goddard.
My guest is Glen Kellaway, mortgage broker for Mortgage Architects. His website, mortgageitright.com, MTGITRIGHT.com. Welcome to the show, Glen.
Hello, thanks. Thanks, Jim.
There's talk of raising interest rates in the U.S. In December. What's happening with interest rates in Canada as it might affect your mortgage?
Well, of late, the bond rates have been going up. They've trended up back earlier this year, the bond rates. Remember, maybe let's step back here. Bond rates drive fixed mortgage rates. The Bank of Canada's overnight rate, which drives the prime lending rate, as the Bank of Canada describes it, drives the bank's prime lending rate. So bond rates are looking like they're going to go up in the United States. Bond rates in Canada have already trended up. So that means that there's upward pressure on the current fixed rates that the lenders are offering. And if you've been watching the lending rates, you'll find that the mortgage, 5-year mortgage that's being offered maybe at 2.69, 2.59, is trending up to, say, 2.79 or 2.89. It's gone up by about 0.2% on the mortgages. So as the bond rates go up, that means whoever's looking to get money to loan, to borrow money, they're giving a bond to repay the money. Governments, large corporations, municipalities, they're going to offer more return on those dollars. And the United States is pushing up their bond rates, or looking to push up their bond rates. They've been holding them back, the government, through various actions in the United States. They're allowing that bond rate to float up, and that's going to increase the cost of borrowing for homeowners in the United States and other borrowers, but those with fixed income, usually in the older demographic and large portfolios, are going to get a slightly higher rate of return.
What happens if the house that you own goes down in value and you've taken out a huge equity loan? We'll just say, we'll have ballpark figures. Your house is assessed at $500,000 and you've taken out $200,000, and if it drops in value, how does that affect the loan?
Okay. So if the loan is secured by the property, and assuming that you're not in default, the lender's just going to look to continue getting that payment stream. This has happened a number of times throughout the last 20 to 30 years. And in the times of correction, there are people who owe more on their mortgage, 200 versus 500. There's still lots of equity, 200 mortgage, 500 value home. Even if the property was to correct and be only worth 400, you still have 200 on a 400 value. That's half loan, half of the value. So the bank's just going to collect that. Lines of credit, lenders might decide to clip those. So if you had a big line of credit, and most people don't now, because if the government, by legislation, has cut back the amount of line of credit that you can take out against your property to 65% of the value of the property. There are still people out there with, say, an 80% or 90% line of credit on their property by virtue of that being put in before the legislation changed the limits on that. But let's just say if it's a normal fixed rate or variable rate mortgage and you're paying on it, and now you owe more mortgage than your property, the bank will just look to continue to take that. And in most cases, I can't say always, but most cases they're going to offer you a renewal when it comes up for renewal, unless you're in default.
Should people start looking at locking in now in this kind of atmosphere? Locking
in for going from their variable rate mortgage, which may be, say, 2.1, 2.2, 2.3%, so prime is, most of the banks have their prime set. Remember, prime is set by the government as a number, but the banks, TD, Scotia, Bank of Montreal, they'll all set their own. It's Bank of Montreal Prime, Scotia Prime, and that prime is sitting at 2.7% right now. There's a discount off of that, so someone might have a 0.6% discount. So their current variable rate might be worth 2.1. if they go to lock in today into a 5-year or say a 5-year fixed rate, they might be paying, say, 2.79, 2.89. Got to look at that difference between, say, 2.1 and say 0.7% increase. And they got to ask themselves, am I better off when do I think prime is going to go up? And this is a calculation thing. Do I think prime is going to go up fairly soon? The Bank of Canada is going to influence the overnight rate, thereby driving up the prime rate. And if that's going to happen soon and it's going to go up dramatically, then yes, locking in makes a lot of sense. But for people who've got good cash flow and got good resources and can stay the course and manage some changes in payments, the prime lending rate going up, right now it would appear that staying variable is probably beneficial for most clients who've got good resources and good net worth.
So it all depends on personal circumstances.
Big time, Jim. It's really a calculation here. Take a couple of $100,000 of mortgage. You've got someone sitting at 2.1%, and let's just say they've got another 3 years left on their 5-year variable. And we're seeing the fixed rates trend up. They've gone up, about 0.2%, 0.3%, 0.4%, depending on where we look back at the beginning of this year. So they've gone up. So if I lock in, I'm going to lock in at a higher interest rate. Let's just say I'm going to pay an extra 0.5% more for the next 3 years. So that would be on each month. Well, if prime just goes up at the end of your 3 years, and it's going up towards the end over 2 years from now, because current forecasts right now are the Canadian economy is not going to be doing that well. So the probability of the overnight rate going up, remember that's what prime is driven by, the overnight rate going up is low, at least for the foreseeable till the end of 2016 and probably into 2017. So if someone's got 3 years left on a 5-year variable, they're probably better off to stay with variable and not lock in. If they can't sleep at night, then maybe it's worth paying the extra interest and lock into a 5-year fixed. But again, case by case, and we also have to look at what else are they carrying? Do they have other car loan debt? Is there something else they should be paying that extra interest on? So it's case by case, Jim.
We'll have more with Glen Kellaway right after the break.
I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
In Goddard we trust.
Welcome back. We're speaking with mortgage broker Glen Kellaway. Glen, again, how important is it for people to shop around when it comes to doing a mortgage, going through a broker, or convincing their bank that they can get a better deal? Because I've heard some numbers as high as 40 or 50%. When a piece of paper comes in the mail saying time for your renewal, just sign this, they just sign it. They don't look for better rates. Is that a good idea?
You know what? It's very true. The banks will generally try and offer you a lower rate. Their posted rate may be, say, 4.79 or 5% in that range. So if it's that range, but they're offering the new customer coming into the branch, say, 2.79, they're typically at renewal offering the client something that's higher than their bottom end. And they say call for special rates. So yes, you can absolutely call for special rates and look at that. Sometimes they'll offer special deals. So your question was, is it important for you at renewal to go and check whether the bank is offering you the best deal or not? Yes, it absolutely is. Mortgage broker versus bank employee, bank specialist, someone who knows about mortgages, we perform a similar function. But the mortgage broker has access to many more product lines and other lenders who offer the same or better pricing than maybe the bank does. Exit penalties are something that bank employees will not talk about for the most part because most of the major banks have higher exit penalties. So locking, basically renewing with your bank, you may be paying a higher rate. If you don't check, please check. And also understand, if you ever had to pay that mortgage out and you weren't going to port it, what would be how do they calculate that exit penalty? And is it something rather that you should think about?
Now, exactly how much would an exit penalty be?
Well, it's going to depend on how they calculate it. Exit penalties for most of the major lenders and many credit unions, they take a posted rate and they take a discount off of that. So let's just say it's 5%. And they take a 2% discount, so they're going to give you, say, 3%. Then if you go to exit from that, say you're getting divorced or you've got to move somewhere else and no one's paying for that, you've got to sell your place because you can't go somewhere else, can't take that mortgage. Now they're going to take the 3-year rate that's comparable to posted, and they're going to take a 2% discount off of that. And go from your 3%, which is what you got when you got started with your 5-year, to something that could be, say, 2%, their calculated 3-year remaining rate, and then they're going to take that difference between those two rates and calculate your penalty. The lenders that do a more favorable calculation just go from discounted. Hey, you got 3%. Our best discounted 2-year rate is actually higher, so it's 3.25. So now there's no differential. They revert to a 3-month interest. So I know that sounds real complicated, and it is, because most bank employees can't do that on the back of a napkin, even if you ask them to do that. They have to punch it into a computer or whatever it is, and they'll tell you can't. Most banks now have the ability for the average customer to go to their Scotia, Bank of Montreal, National Bank. You can go to their customer site and find out and punch in your specifics on your mortgage and calculate what your penalty will be. I have a current client right now. They got $600,000 of mortgage with the big red bank, and they've sold their property. They have 90 days to port their mortgage, and their new property is probably not going to be done in time to port their mortgage. I did the math. I said, you got to add, basically you got to keep that. It's too expensive at $26,000 to pay out their $600,000 mortgage. You got to stay with that, even though that interest rate is like 3.09. You got to stay with that, and we'll put you in a variable rate because it kind of offset the difference. So they got a low variable rate for the new part. They're buying $1 million property. So combine those two, and it works out to be a better deal for them. 2.5 years from now, it'll be time to reset everything and take a look at what's the best deal out there.
I've heard there's been a big rush to buy real estate in Vancouver and Toronto because people believe interest rates are on the eve of climbing, so get the lowest mortgage you can now because you'll never get a lower one again.
There is some truth to that. I mean, I still think interest rates are still going to stay fairly low. I don't think interest rates are going to go back to the 8, 9, 10% when I first got into this industry, and higher when my parents were taking a mortgage out just as I was coming out of high school in the early 80s. But right now, interest rates going up by 1.5%. People who are buying, and I do this for my clients, I can't speak to everyone else. I know really good, qualified experts will go and they'll stress test the mortgage for someone. They'll say, Jim, you're going to take that out. Today's interest rate is 2.75% or 2.79. Let's just imagine 5 years from now, it's 3.79 when you go to renew. How are you going to feel? And they're going to look at the ratios, your ability to service that debt, also knowing that you've got 5 years left on whatever term it is, and they're going to say, okay, so if you buy at the upper end today with the lowest possible interest rate, when it comes up for renewal, even if you get the best rate you can from your existing lender, you might be house rich and cash poor. So I invite everyone to make sure that they get someone to tell them what is it going to look like if the interest rates are 1% higher than they are today when I renew 5 years from now. How's it going to look for my debt service ratios?
And also something that people should factor in when they're buying a house, the maintenance of it. Because I've been told studies show if you have a house for 25 years, the average period of a mortgage, you're going to put in maintenance about what the price of that house is now. So or what you bought it for. If you bought it for $500,000, by the end of 25 years, you've put in about $25 million worth of repairs and renovations.
Well, I agree with you on that, Jim, because your average roof is $5,000 to $10,000. It might be more. You need to paint it every few years. If there's a wood deck, it needs to be rebuilt. So you got to set aside, $200, $300, $400 a month, $3,000 to $5,000. I would say $3,000 to $5,000 a year, even if you don't use it in that year, something or other or more. I'm not sure about the full value of 25. you know what, five to $5,000 a year probably for a maintenance budget. And again, some of that stuff might be drain tile that needs to be done in 5 years, or it might be something else that needs to be repaired. And that's not, I want a new kitchen. That's, I need to fix something other. Updating is another thing that has to happen, because a house, like your old 67 Fairlane or whatever it is, or my old Valiant when I was first driving, I mean, you can only do so much to maintain it. You need to refresh it. You need to update it. So speaking with my real estate hat on, I would say you need to make sure that your home is constantly being updated. That's not just a new roof. That's maybe changing out the kitchen cupboards because they were in 20, 25 years ago. It's changing the look and color and maybe the railings in the house. All these little things go to maintain the value of a house. But a 30-year-old house or a 40-year-old house or a 60-year-old house is still a 60-year-old house. It's just an updated house. And when you compare that side by side with a brand new house, even though they've both got granite countertops, the brand new house is going to have a higher value because it's got a slightly longer life expectancy being brand new.
Yeah, well, hopefully the guys who built it like they used to in the old days. And I watch the way they throw up stuff right now. I don't know if I'd be happy to buy that property knowing what's on the inside of it.
Oh, I'm going to have to be careful here with what I say. I have some concerns, having seen a number of houses. Yes, you need buyer beware, and the buyer needs to. I highly recommend a good home inspection, and at least that's basically your seat belt without airbags. But a lot of people out there will go and buy stuff. They'll do it themselves, thinking that they've read enough on the internet, and as that commercial shows, and those other ones where the SWAT team comes in and says, "Oh, didn't you know this was a drug house before?" They bought something or other, and that's a problem. People can buy stuff and do it themselves, and they might end up buying something or other that they didn't understand was a problem, and they'll discover afterwards.
Yeah, you don't have Captain Obvious from the Hotels.com site helping you out.
You kind of wish you did.
Yeah.
But anyways, every area, mortgages, real estate, every area has a level of expertise that someone who's working actively in that area will gain. And then there's other individuals in that area, I would put myself into that, who've got a higher level of experience with all the courses we take and all the different deals we've worked on that give us more experience than the average person in that industry.
Does it cost you any money to use a mortgage broker?
Good question. And does it cost any money to use a mortgage broker? I would say most of the time not. Let me put an example in there. I'm just looking at a large gravel mining operation for a client in Smalltown in Golden, BC, and there's some commercial property that's going in there, and it's going to be more of a private investor stuff. In that case, where it's private money, or it's non-big bank money, or it's a commercial mortgage, I get paid by the person I arrange the mortgage for, just as you would pay your lawyer or pay your accountant. But where the bank is arranging, where I'm going to a major financial institution, a TD, a Scotia, a National Bank, one of the credit unions, or one of my non-facing, in other words, my other lenders who will loan money at the same rates or better than TD will, at better prepayment privileges, those lenders will pay me. So I find the client, I get everything ready, I send them the file, it's all pretty with a bow on it, they say yes, all paperwork signed, they send me a check afterwards for finding them a nice client. And it doesn't cost the client anything. I just ask the client to stay and work with me, and if you like what I did, pass my name on to 2 other people. So
right now, overall, no need to really panic about rising mortgage rates. Where even if they go up, it's not going to be a sudden jump of 5 or 6%. No, I can't forecast that, but I would say in the short term, my take on this, and it's echoed in the various news economists and whatnot, Canada's going to borrow money. They're looking at a deficit. Unfortunately, Justin's inherited what looks like it's going to be a deficit based on oil prices being down and resource. We're a resource country, so we're not going to be generating as much revenue. And there's rising unemployment in some areas where it's flat. That being said, so we're not getting as many tax dollars, and Justin's going to go on a spending spree to put infrastructure in. Good, bad, or otherwise, Canada's going to have to borrow money. If Canada's going to borrow money from the world and from various other sources, they're going to have to push up their bond rate. So when they say we want to borrow money, they're going to offer a bond.
and that bond rate's probably going to go up. The fact is the United States is already pushing up the bond rate, and the bond rate is driven separate and distinct and different from the overnight rate, which prime is based on, and the variable rate mortgages and most credit cards. So back to your question, are we going to see fixed rates jump? Yes. Are we going to see them jump dramatically? Probably not dramatically. A quarter point, a half point, they've moved 0.25%. Maybe a 0.5% would seem reasonable. The overnight rate, prime, I doubt is going to move dramatically. It's certainly going to stay flat. Is it going to fall back? Probably not. Is it going to go up a little bit? Not for the next year, probably, or two. So is anyone going to be devastated by their payments going up by a half or doubling? No. I don't think so. But if you're going to buy real estate, mortgages are low, just make sure you're buying well within your means and work to pay down that debt.
Glenn, thanks a lot for chatting with us. My guest has been Glen Kellaway, mortgage broker from Mortgage Architects from mortgageitright.com.
That's right. Thank you, Jim.
Thank you. You're listening to the Goddard Report on TalkDigitalNetwork.com. Find us on Twitter at TalkDigitalNet. Our popular YouTube channel is Talk Digital Network. Comments about the show can be emailed to info@HowStreet.com. I'm Jim Goddard.
Comments made on the Goddard Report and TalkDigitalNetwork.com are an expression of opinion only. The Goddard Report is available online and mobile at TalkDigitalNetwork.com. The Goddard Report is a production of How Street Media Incorporated.